All right. Matt, why don't you go over the housekeeping one more time?
Yeah,
real
so
quick?
for people that maybe just entered, we have a presentation for you guys, kind of kick off the tax season, introduce the firm to you all. Basically, we're planning for it to be about 30 minutes. All of the participants that are clients that are in this meeting right now, we've muted you. The cameras are off. There's no way to turn them off, so nothing's wrong on your end. If you do have any questions throughout, feel free to use the chat. We'll be monitoring it. Again, 30 minutes roughly is what we want the presentation to be. So at the end, we do have if we have time for a Q&A, we'll go ahead and kind of do a little back and forth, discuss some of the topics you may have. If something's a little too in depth, maybe we do something like this, a webinar type thing in the future to go over a topic. Or we'll get back to you at a later date. And I'm going to kick it over to David Duben.
All right, let's go to the next slide. So quick on the agenda, we're going to go through staff introduction, at least so you guys can put names to faces to voices so you know who's working for you. We'll go over the purpose of this webinar, high level. We'll go into some 2022 tax highlights. We'll go into 2023 things you should keep in mind for this year. Then we'll get into what we need from you in the near future, like the next 45 days as we're getting ready to prepare your tax returns. And we'll go over what you can expect from us and what we expect from you. Like Matt said, if any questions come up or things you want to go into, please use that chat function. All right. Let's do next slide.
So you want me to just admit these last couple people?
Yeah, let's go ahead and admit these last people. All right, so staff introductions. I just wanted to, go over a few things. We obviously made some big changes. All of our clients are going to be assigned to a partner as a primary responsibility. Each partner is going to have a dedicated account manager and a staff accountant to help support the clients. But the firm is all using the same tax practice management, tax software. So anybody within the firm, if you have questions and your team isn't available, we should still be able to help you or answer any of your questions. JC is our communications director. She's the glue that sort of keeps this all running. So she will be all of our primary contact point. And that's mainly because that's her job. It's not to be a gatekeeper. It's more to make it more efficient during busy times of the year. The partners and the accountants are heads down usually, and they may not be able to monitor the phones or the emails as quickly as Julie can. So please use that resource. I just wanted to turn it over to everybody. Obviously, my name is David Duben. I'm the primary partner, I guess.
You're the president.
I'm the president. Christy's our partner and vice president.
Hi, everybody.
You want to switch it over to?
And again, I'm Christy. I'm so glad you joined us this evening. Thank you.
Yeah, we're doing quick staff introductions. So I am Matt. JC.
I'm JC or Julie.
And then I think
I'm
we'll
Mark
kick it over.
Matthews,
Yeah.
one of the Marks.
And I'm the other Mark. I'm Mark Richter.
Last but not least.
I'm
Tracy.
Tracy. Hello.
All right, so we're going to get into the meat of the presentation now. First I wanted to sort of recover why are we having this webinar. Obviously, two main reasons. One is we have, dramatically changed our firm's focus. And two, 22 tax season is already here. So you've probably already started to receive or are still receiving a lot of your tax docs. But I just wanted to give a little bit of background on why we've changed the firm's focus and why we're moving from being a tax preparation firm to an advisory firm. Last year, we had some major staff changes. One starting obviously with my father's passing in December, and two with the retirement of Cindy Bianchi in basically May of last year. So we lost two of our tax preparers that were very active with us and had been for many, many, many years. And it caused us to basically reevaluate the firm. It became clear to us that we either had to hire more people and keep doing what we were doing, or we needed to change the firm and put it in a new direction. With basically an all hands meeting that we did in June, we reevaluated where the firm was, what we were doing, whether it was value add for us and for our clients. And the bottom line was we were doing a lot of work for a lot of clients that probably didn't need CPA services, but were still using us because, well, that's who did their taxes the year before. But we didn't feel that we were giving the level of service to the clients that really did need CPA services, that needed to understand the tax laws and the complexities and the changes. So we are no longer just a tax preparation or ad hoc accounting firm that will try to serve everybody. We are really narrowing our focus to clients like yourselves. We have a concentration of first responders. We have a lot of real estate people. We have a lot of professionals. We have a lot of people that own their own businesses. We are focusing our firm in that direction. And our goal is not only to prepare your tax returns once a year, but also give you advice on how you can minimize your taxes or increase your financial stability. And it will be a year-round service.
To be available when life crops up.
Mhm.
If you are going to sell a property, if there's a passing in the family, the stuff of life, we're here for you and we'd like you to use us and leverage the service. That's the intent. Our tax meeting should be our tax meeting, and that should be a snapshot in our financial year. Every other month should build to that. So that's the goal.
And the goal is too that you shouldn't worry about picking up the phone and worrying that we're going to send you another bill. You've
Correct.
already paid for the service, so we want you to use this, and we want you to use this timely, not at the last minute or wait till your tax time to try to figure out your year's worth.
And that's where JC comes into play, because really and truly get on our calendars and then we'll give you a call and we can discuss whatever need has cropped up.
The other reason for this call, obviously, is 22 tax season is here, and we do need to get your taxes done. It's still a key deliverable for what we are providing you. And that is a timely thing that has to be done every year, and hopefully we can do it by the due date. And if we're not doing it by the due date, it's not because we couldn't do it, it's because you chose to wait. So it's your decision, and a lot of people can't do their tax returns by the original due date because they're still waiting for information from investment companies or other partnerships. So we understand that. We just want to work with you to make sure that you're making timely payments and estimates, so you're limiting or minimizing your penalties and interest. So I'm going to go over some 22 tax highlights for you over the next few slides. First is due dates. If you have a partnership or an S corporation, the due date is March 15th, 2023. So that's coming up literally in a month and a half. For individuals, foreign bank account reporting, trusts, those are all due April 18th, 2023. For corporations that aren't an S corporation and are on a calendar year, theirs is also due on April 18th, 2023. Now that I've said that, everybody that lives in California, for the most part, all of those due dates I just mentioned have been extended automatically till May 15th. It's not only an extension of time to file, it's also an extension of time to pay. They won't start adding penalties or interest until May 15th. So all items that were due for those earlier dates have been extended as long as you live in a California county that was declared a federal disaster area because of the rains in January. So people will be making fun of all those Californians that we can't drive and we can't do our taxes on time because it rained.
Doesn't that also include fourth quarter estimates?
It included fourth quarter estimates that were due in January.
Yep.
Unfortunately, by the time California conformed to it, it was too late for us to let everybody know.
Let's just
But if you did miss your January 15th, you actually will not be penalized for a late fourth quarter estimate. It's not due until May 15th, which essentially means you don't have to pay your tax until the due date. For our clients that are outside of California, unless you had a federally declared disaster in your state or county, your due dates are still those dates up above. All right. Some 22 tax highlights. I sort of broke these into bad news, good news, and I couldn't really decide if it was bad or good. But the bad news first. Your refunds are likely going to be down if you receive child tax credits, if you got benefit from charitable deductions, if you had dependent care in 2021, if you received the stimulus tax credit in 2021. So please be aware that your refunds, if you got big refunds last year, they could be lower this year. So the big one is the child tax credit. If you had dependents that were 17 or under, you were actually getting $3,000. And if they were younger, I believe it was 6, they were getting $3,600 per dependent. And the income limits were raised. The income limits are still higher for 2023, so they don't start phasing out until 400,000 in AGI. But now you have to be under 17 and they're back to $2,000. So if you have a child that reached 17 last year, you're not going to receive that $2,000 credit for 2022. There is a difference, and I think people get confused between the dependent care credit and the child tax care credit. The child tax care credit or child tax credit is for anybody that has a child. The dependent care credit is when you have a child that's under age 13 that you're putting into after school care or have a daycare provider that watches your child while you're at work. Depending on your income level, you're entitled to a credit, which is a percentage of the amount that you pay for that dependent care, up to a maximum of 4,000 or 8,000. It was 4,000, 8,000 last year. In 2021 tax return, this year it goes back to the 3,000 and 6,000 limit. So just be aware that those credits are reducing, which could impact your refunds. The other thing is the charitable deductions. Unless you're itemizing in 2022 for the current tax return we're going to be doing now, you're not going to be able to take any deductions for charitable donations. In 20 and 21, due to COVID, they were allowing even people that took a standard deduction to take up to $300 if you were single and up to $600 if you were a married couple. So this year, that charitable deduction is gone for people unless they're itemizing. If you're itemizing, you're still able to claim charitable deductions. Question on itemized deductions. We can get into that in more detail, but if you're itemizing, you're only itemizing if you're single, if you can itemize greater than 12,000 plus in deductions. Otherwise, you're taking what's called a standard deduction. If you're married, it's all the way up to 25,000. Almost 26,000 this year. Yeah. It differs depending on whether you're single or married filing jointly or head of household. But you have to get above that threshold before it makes sense to itemize. A lot of people, unless they have homeowners insurance or have
Mortgage interest,
it's difficult for federal purposes to get above that standard deduction.
Since they raised it back in 18.
Correct. So unless you're very generous with your donations, it's very hard for you to get over the threshold.
If you're thinking about making a substantial contribution in 2023, bring it up during our tax meeting, just so we can see if it makes sense to take that course of action for tax purposes.
Agreed. I think I always try to tell people it's not a dollar for dollar donations or credit. When you make a donation, you should be doing it because you want to donate money, not because you're trying to minimize your taxes. It just, a lot of times it doesn't make financial sense. It still makes good sense if you're wanting to donate to the charity. Last one on this slide for bad news is the California pass-through entity tax. I know we reached out to a lot of clients last year. We're going to reach out to even more clients this year. It is a valuable deduction or credit that is out there that allows people that own their own businesses that are pass-through entities like partnership and S corporation to get around the state tax limitation. However, last year we were able to take advantage of that credit even if you didn't make the payment timely. You had to pay a little bit of penalties and interest, but you were able to still make the election. For the 2022 tax year, that's not possible. You had to make your estimate payment by June 15th or make at least $1,000 payment if you didn't use the election the prior year by June 15th to qualify to take the election in 2022. So unfortunately, if you miss that June 15th payment, we're not going to be able to use the pass-through entity tax credit for this year. We will be working with all of you that can qualify for this tax credit to make sure that you at least have the option to make it for 2023. There is work in California Congress to try to, there's basically lobbying groups from the AICPA, the Cal CPA, all of the tax lobbying groups are trying to get this addressed through Congress to get it fixed. But unless that law changes, we really have no option.
We'll see. Stranger things have happened.
They have. Last year, they didn't make the change until mid-February. So we can cross our fingers, but as of right now, it's a hard test and there is no workaround at this time. All right, bad news aside, good news. For 2022, if you own your own business or if you're, well, actually only if you own your own business, you're still allowed to deduct 100% of your business related meals. This is up from the 50% a few years back. So last year, we will be able to deduct 100% of your meals for federal purposes. The energy credits have gotten better with the passing of the recent law. The solar credit is back up to 30%, and it includes not just the solar panels, but it could also include other related solar energy items such as battery storage walls. It's 30% of the cost of the equipment and the installation costs, so it is a very lucrative credit. It is non-refundable, but it is a very good credit for those that pay tax, and it will carry forward so you don't lose the credit. The updated electronic car credit, this one I vacillated on. It could be also an additional news. I can't tell if it's 100% good news or 100% news. They made a lot of changes to this credit. So if you bought an electronic vehicle in 2022, we're going to need a lot of information to figure out how you can deduct it or get the credit this year.
And for starters, it has to be new.
It does have to be new for 2022. They did add in a caveat for used vehicles, but those used electronic vehicle credits are iffy. You have to meet certain criteria. They have to be bought through a dealership. You can't buy them through a private party. And they're only good once. Meaning if that used vehicle was bought and then sold back to the dealership and he sold it again, and then somebody sold that same car back, it's no longer available. So we're not sure how the IRS is going to track it. But it's not as easy as, oh yes, every used car dealer is going to, or used electronic vehicle is going to be eligible for credit. Some of them aren't. And leases still are not. The leases, the law reads and it includes leases, but when it says it, it's talking about the lease company, not you as the purchaser or the consumer. So if you lease a car, the person that leased it to you is actually getting the credit. There are some lookup tools. So if you have, again, if you bought an EV car, just let us know and we'll help you figure out if there's an eligible credit. Do not rely on your salesperson. All salespeople will tell you all cars are eligible. They're just
I want to sell the car.
They want to sell the car, so they'll tell you whatever you want to hear. The ability to open, this is new. So you have the ability now to open up a solo 401k if you are in if you have your own business. These solo 401ks you can actually fund and open now for the 2022 tax year, all the way up to the due date of your return, including extensions.
So I can be a sole proprietor, I can have an S corporation.
And some partnerships, if you have self-employment income through your partnership.
And how's that different from a SEP?
So a SEP only allows you to contribute 25% of either your profit or your self-employment earnings.
So my W-2,
If you're an
Not
S
like-
corp, you're going to look at your W-2. If you're a partnership with guaranteed payments or self-employment income, you're going to look at that self-employment income on your box, but it's limited to that 25%. The big difference for this solo 401k is really going to come in for S corps that they're paying themselves compensation, which all of you should be if you have your S corporation. But what it allows you to do is you can do the employee contribution, which last year allowed you to put away $27,000 as your employee portion of that contribution. And then the company can also match 25% of your salary. So the difference there is you have to, with a SEP, you can only put away 25% of your salary. With a solo 401k, you can put 27,000 plus 25% of your salary. So it allows you to really defer a lot more income with a solo 401k.
and this is for me, myself, and I, correct?
Yes, it has to be the owner of the company. It will allow for more than one owner, but they have to be like greater than 5% shareholders. So like husbands and wives can be there, but if you've got, you can't do it if you have other employees. If you have other employees, you're gonna have to open up a traditional 401k.
Which is what we're gonna talk about a little bit down the road.
Down the road.
Back 2.0.
Yes.
Yep.
Another one that I thought was good news and something I just learned the other day is cryptocurrency and wash sale rules. So for those of you out there that have cryptocurrency, I'm not an advocate for cryptocurrencies. But if you have already on that boat, there may be some tax strategies we can employ that would allow you to take advantage of the downturn in the cryptocurrency market. Normally, when you have stocks or bonds, if you sell stocks, you can realize that loss, but you can't buy that same stock back in this 30-day period. If you do, you run into these wash sale rules that disallow the loss. Cryptocurrency is not subject to those wash sale rules. So technically, you could sell a cryptocurrency, take a loss, and then immediately purchase it back and still basically own the same security you did 3 minutes ago, but you can record a capital loss for your tax purposes. So for those of you that have cryptocurrency, you might want to give us a call and see if this is a strategy that'll work for you. Again, all of these come with risks, so don't just do it because I said it on the seminar. You should probably reach out to us first before you do anything. How am I doing on time?
We're
Okay.
at 5:59, almost 6 o'clock.
All right.
We
so-
started about 10 minutes late.
All right, so we're getting closer. Some other news for those of us that are in California, a lot of us have received these mystery money network cards in the mail from the state of California. You may have received direct deposits. These were the middle class tax refunds that were signed into law last year by Newsom. They were meant to combat inflation and give the middle class some additional money to help fight it. The payments started going out in December. They are still issuing these payments through January. The good news here is it is real. Those cards that you are receiving, you can use as visas or credit cards. If you do, they'll charge you some fees. You might want to just transfer the money off and put it into your bank account. The good news is it's not taxable for California. The reason it's an additional news is we don't know what the IRS is going to do. We're still waiting for formal guidance on that, but they are issuing 1099s, so we're most likely going to have to report it. We're just not sure if we get to back it out.
Well, it's technically a tax refund.
Except
So
there's,
it's a
they
little-
wrote it as that it's not a tax, so it gets complicated. I think, I don't know.
Yeah.
Worst case scenario is we're gonna have to pay some tax on it,
Yeah,
but you've
you
still
still
got
got free
7,
money.
you've still got free money, exactly. The mileage rate increased twice last year, so it went from January to June, it was at 58.5 cents a mile. From July to December, it was 62.5 cents a mile. What that means is for all my business clients that like to tell us same as last year, it's not gonna be same as last year. You're gonna have to get us a little bit more detail and break it down by how much did you drive in January to June and how much did you drive July to December. Businesses with non-family employees, besides themselves. I'm sure all of you have heard the ads on the radio driving in, advertising employee retention credits, saying that these companies can get you up to $26,000 or $27,000 per employee. There is an employee retention credit. It is a real credit. I highly caution you that a lot of these companies are not acting in the best interest of the people they're trying to get the credits for. Their fee is based on the amount of the credit that they get. They are having you sign you're essentially signing a 941, an amended payroll tax return to claim the credit, but you're ultimately responsible for what you sign. It may take the IRS years to audit all of these, but at some point they're likely to audit. And you should be very leery of accepting these things if they're giving you 100% credit on every employee. It's just not possible, especially if you took PPP money. So please call us. We can help you actually file for this if you meet certain tests. But there are some gray areas to the law that these companies are saying, oh yeah, you can qualify under this, and probably not. So just be careful. So things to keep in mind for this year that you should be aware of. If you are retired and reached age 73, that's the new RMD rate. New RMD age. So that's the age that you have to start taking required minimum distributions out of your account. If you're going to turn 73 this year, make sure you talk to us. The standard mileage rate for business owners, it's gone up to 65.5 cents this year. So it actually went up again, another 4 cents. The bonus depreciation on assets with less than 20-year life. So this was allowing you to fully expense items less than, if they had a life under 20 years, you could fully expense them year one with federal bonus depreciation. For 2023, that is currently dropping down to 80%. Now, there's still the old tax law on the books for Section 179, so there may be ways that we can still, get you 100%, but it's not going to be across the board anymore. Remember that business meals are no longer at 100%. They're going to be at 50% this year.
What about entertainment?
Entertainment is still 0%. Yes, and it was off the table for 22, and it's been off the table since 2017. So if you're still including entertainment expenses in your meals account, you should break that out. You still get to deduct it usually for states, as long as they didn't conform to federal law. But like in California, we're still allowed to take entertainment expenses. It's just 50%. Okay. But for federal purposes, you cannot deduct entertainment expenses. There are going to be some new energy efficient credits. In the past, you were able to deduct if you got windows and they were energy efficient, you were allowed to get a $500 credit, and it was supposed to be a lifetime credit, meaning even if you put energy efficient windows in 5 years later, you didn't qualify for that credit anymore. With this new tax law, they've actually increased the dollar amount for the credits, and they've made them so that you can apply for them annually. So if you put in windows, You can get up to 30% of the cost of the windows to a maximum of $1,200.
And that's not hard to get to.
No,
And everything's
no.
energy efficient now, refrigerators, washing machines. A lot of people have been waiting for
Yes.
larger appliances, so let's remember to talk about
What
that
you would
during
want to
our
do
meetings.
is there is an aggregate, so it caps out, it's like $600 per item, and it caps out at 1,200 or 2,000, depending on the type of item. And then overall, it's going to aggregate out at 3,200. So if you're planning to do some big improvements in that area, you may want to saddle your years. You may want to plan it in December and January so you can buy some of the stuff in December, max out the credit for that year, and then buy other items
Yeah.
in January, max out the credit for the following year.
Yeah, perfect.
And there are a lot of new changes in the retirement code section for the IRS, especially around 401k plans, 403b plans. A lot of these are favorable to the participants, but they are going to require the employers to make amendments to their plans before they can take advantage of the law changes. So this note is really just to keep your eyes and ears open for changes that your company may be making to their plans to open up these new opportunities. There's talk of being able to add a emergency savings account into 401k plans that employees can dip into. There's talk of adding new Roth options that participants can take advantage of. So there's a lot of favorable things that could be coming on the horizon, but like I said, the employers need to make changes first before they can take advantage of a plan.
Probably something we'll host a detailed webinar about a little
That
bit
would-
later in
yes.
the year as they impact the bills.
Yeah, especially for people that are looking for ways to maximize retirement.
It'd be good for employee retention too.
Yes. Sorry, wrong way. All right, so that's all the 22 tax highlights and sort of the 23 things to keep in mind. We'll let you know of others that are out there, but these were the most broad ranging and applicable to everybody on the call type. What we need from you in the near future, and this is for the stuff to do your taxes for this year, is we need you to keep an eye out or get all of your tax documents together and to upload those to the portal. So for individuals, it's W-2s, it's 1099s, it's all those tax documents that you get. It's organizing your itemized deductions. If you need an organizer, reach out to JC. She can prepare an organizer for you and get it out to
I
you.
think for those who have access to the portal, JC, you have already prepped.
I have almost everybody that accepted the new engagement, has been, given a tax organizer in their portal, and I sent a link.
And is that
And
custom to their prior
It
filings?
is custom. If they had prior filings with our firm, it is based off those numbers.
Okay, and if anybody has questions, reach out to JC.
Yeah, and if you didn't have a filing with us last year, I can still send you an organizer, so
great.
please let me know.
Okay.
One thing to note for a lot of people with banks or brokerage accounts, you may have already clicked a button that says you agreed to electronic communication with your financial institution. If you've done that, they are likely not to mail you a hard copy of your 1099s. You're going to have to log in and go to their statement section and look for tax documents and download them yourself. So just because they didn't send it to you doesn't mean that you don't have one. It just means that you may have to log in and retrieve it. For businesses, we need to get your financial statements. So we need that profit and loss and balance sheet if possible. And we'd love to have it comparative to the prior year so we can make sure nothing changed since the last time we did the tax return. We want you to upload your docs to our client portal. This is very important for cybersecurity. We are not going to accept documents emailed or sent to us through other file transfer methods. It just violates our cybersecurity process. And we all have to have, tax preparers now are required by the IRS to have a written cybersecurity procedure. So email is very insecure, and if we try to accept multiple, we don't know what the security is on your other file transfers. So for us to be compliant, we need you to use our portal. It is the most secure way for us to manage those documents.
JC, can we even get documents or those, like if a client sends us a W-2, can I open that up in my inbox?
We're not going to be able to open up anything, any attachments that
Okay.
are coming in an email.
Unless they've been pre-approved.
Unless they've been pre-approved, yeah, they will be, thrown out
Okay.
automatically.
So you gotta get used to the portal and get
Yeah.
into the portal, and it's really simple when you're in
It's
there.
very user friendly, and I'm happy to walk somebody through it. I can even send a tutorial video on how to use it. They have one. And for those who feel that they are not they're technologically
They don't
challenged,
like,
I promise that this is a simple system, and once you do it once, you'll
I've
be
had
very
some
happy
pretty
to
good
do
reports.
it.
People are pretty happy with
I
it once
have,
they
I
get
have
in.
I've walked people literally through it from the get-go, and they're very happy once they've done it, and it seems to be very user-friendly.
Okay.
good. Once you have all your docs uploaded, it's time to reach out to JC to get that appointment with us. So give her a call, her phone number's on the slide, or you can email that info@dubencpa.com letting us know. We will also be monitoring your uploads into the Smart Vaults or into your portal. So we do know when you upload certain documents, and we will be starting to work on it, but we need to have all those docs before we can actually complete the return. And if you schedule an appointment before you have the majority of your documents, it's just not going to be a productive tax meeting. So please get those documents in first. All right. What you can expect from us, look, we're gonna prepare the return before your scheduled appointment. That's the goal. And the reason that we can do that is because we have multiple staff working behind the scenes. It's not just Christy or I doing input for your tax returns. Christy or I are doing the final reviews, and we're meeting with you. Sometimes our accounting managers are meeting directly with you as well, but we need to get the information, but our goal is to prepare the return prior to our appointment. Once we meet with you at our appointment, like Christy said, that's really should be a pretty easy call. We're just going through the tax return, highlighting what happened for the year, and then highlighting some strategies that we can implement for 2023. We can always schedule a follow-up call to go into more detail on the strategies, or if you have deeper dives that you want to go to. Doing it at tax time is probably not the best time. We're still going to be busy during February to May doing tax returns for the clients.
And that's the accumulation of the prior year.
Yes.
So the idea is, let's get through the accumulation, get the return filed, and let's look forward to 2023 and have 9 months, 10 months.
To really dive in and make sure that when we hit 23 tax returns, we're actually a step ahead, not behind. So don't try to cram it all into one appointment is what we're
You
trying
don't
to
need
say.
to.
We don't have to, you don't have to.
So, yeah.
There should be more time for us to do it at a more reasonable pace. We'll be reaching out to you throughout the year with a new important reminders. Hey, your estimates are due. Hey, there's been a new tax law that may impact you. We may put on more of these webinars for deeper dives. So just keep an eye out for it. We're not trying to bury you with monthly tax letters or monthly or daily emails, but when we do reach out, it's probably because we think it's important information you could benefit from. And we are available year round. If you need something, need advice, please give JC a call. She'll get you on the calendar or get you to the right staff person to help you out. What we want to make sure though is that, let me just go to the next slide. That look, what we expect from you is this is a partnership. It's mutual respect is both ways. We want to treat you with professionalism. We expect you to treat us with professionalism. But we want you to leverage us. Make sure to call us before you do a major financial decision, not after. And give us time to help you make those decisions, not the day your escrow is closing that you need something right now. We want to help you with the 1031 exchanges way before you actually get into a 1031 exchange. If you receive notices from a government, scan and upload them as fast as possible so we can get working on them. Even though it'll take the government months to resolve the issue, they still expect you to respond timely. So if you get a notice that says they need to hear from you by, the 20th, giving it to us on the 19th is not the best way. Give it to us as soon as you receive it. And then to ensure that we're getting back to you with the right people at the right time, go through JC. She has access to everybody's calendars. She knows which staff are available that can help you. And if you can give her an idea as to what you're looking for, she knows enough to get you to the right person quickly. And then we're not trying to do a gatekeeper here. It's not that we don't want to have the conversation with you. It's just that during the busy times, especially, we don't necessarily have the bandwidth to do it when you need it. So the easiest way to do it is through JC so she can schedule it in for us. And did I get close?
I think you're 6:16.
I'm pretty close.
You're pretty close. You're not too bad.
So I don't know if there's some Q&A we can try to get to. I know we're probably right at the limit or a little over. So I understand if you have to drop. We are recording this. We will post it. We will email it to everybody, even for those that weren't able to attend. So
You can always send follow-up questions at your leisure too.
I think
So-
really, sorry, Christy, too, really quick, the only one on there was, I think regarding back to the rain extension
Okay.
question. Does it apply to both federal and state was the
yes, it does. So, and one of the reasons we weren't able to let people know about the fourth quarter is the federal government issued it prior to the January 18th due date. The California did not conform until like the Friday afternoon at 4 o'clock saying, oh yeah, we're gonna do it too. So it was too late to let anybody know.
And that's
but-
for California residents affected by the rain
and
in pretty
there-
much all the counties of California. There
If
might
you
be only
live
one or
in-
two, like
if you
Inyo,
live in Riverside,
San
San
Bernardino,
Bernardino,
LA,
Los Angeles,
Orange.
Ventura, Orange, San Diego, Sacramento, pretty much every major county in California was covered.
I think I noticed if Mammoth Lakes wasn't, but I think that's probably because
They may have added it by now.
I don't
If you have a question or you still have a concern that you're not sure if you're covered, just shoot us an email and we're happy to let you know, or give JC an email and we'll let you know for sure. There is a link that lists all of the counties that were impacted.
And yeah, there was another question that's a little more personal to that person, so we'll just reach back out to you regarding that question too.
Okay.
I think for now, that might be
Okay.
mainly it.
All right, guys. Thank you all for joining. We really do appreciate it. Hopefully this was informative. And like I said, we will post it and make it available for everybody, especially those that weren't able to join. All right.
Thank you.
Have a good night.
Bye, everyone.